How a single rumor shook Wall Street. It began with a whisper, soft, uncertain, and almost trivial. A comment overheard in a hallway, a sentence printed in a small column, a hint that something wasn't quite right inside one of the most trusted financial institutions in the country. No facts, no proof, just a rumor. But sometimes a rumor is all it takes to crack the foundation of confidence. To understand why this moment still matters, we have to return to a time when trust was the most valuable currency on Wall Street. Banks could withstand losses, failed investments, even economic downturns, but they could not withstand doubt. A single suggestion that an institution was weakened could trigger the very collapse it feared. And in an era when information traveled unevenly and emotion moved faster than fact, the boundary between stability and chaos was paper thin. This particular rumor began quietly, an offhand remark about a bank's reserves, spoken by someone who may not have intended harm. Yet the timing was perfect for disaster. The economy was already strained, markets jittery from recent failures, and investors anxious about the possibility of more instability. When the whisper reached the right ears, it transformed into something larger, more dangerous, more urgent. At first, only a few traders reacted. They hesitated on investments they would normally make without question. They sold small positions just to be safe, but fear is contagious. And in the tight-knit world of 19th century finance, hesitation became suspicion. Suspicion became fear, and fear became a frenzy of speculation about what the bank was hiding. Word spread through telegraph lines, coffee houses, and crowded exchange floors. People to know the details. They didn't need to. The idea that the bank might be in trouble was enough to spark unease. Depositors began to withdraw modest sums. Merchants delayed payments. Other banks reviewed their exposure, calculating how much they could lose if the rumor turned out to be true. In these early moments, the crisis hadn't yet taken shape. It was still forming, gathering strength, pulling more people into its orbit. But the tension was unmistakable. The balance of trust was shifting, and the rumor, small, fragile, and almost accidental, was beginning to reveal its true power. Because on Wall Street, fear doesn't wait for confirmation. It moves first, and the consequences follow. The whisper grew legs, then wings, moving faster than anyone could contain it. At first, bankers dismissed concern as another passing rumor. Wall Street had endured countless murmurs before, each dissolving under the weight of ordinary business. But this one did not fade. It spread through private conversations, late-night telegrams, and hurried meetings where voices dropped to anxious whispers. Traders acted first. They began quietly selling positions tied to the troubled bank, disguising their trades to avoid drawing attention. Yet every sale left a trace, and traces, when noticed by the right eyes, become patterns. Soon other investors picked up on the unusual activity and followed suit, not because they knew the truth, but because they feared being the last to act. In markets ruled by instinct as much as logic, hesitation could mean ruin. The bank tried to project strength. Senior officials issued calm statements assuring the public that reserves were healthy and operations were stable. But their reassurances sounded rehearsed, almost offensive, and in times of fear, confidence delivered too forcefully has the opposite effect. It deepened suspicion. Depositors began withdrawing larger sums. Not enough to cause alarm yet, but enough to notice. Inside the institution, tension thickened. Ledgers were reviewed repeatedly. Couriers rushed between branches. Executives debated whether to release more detailed financial statements, fearing that transparency might calm the public or confirm their worst fears. No one knew which outcome was more dangerous. Meanwhile, competitors sensed vulnerability. Some banks subtly tightened credit to businesses connected to the institution under scrutiny. Others spread carefully worded concerns to protect themselves, though every whispered warning added fuel to the growing fire. In an interconnected system, self-preservation often came at the cost of someone else's stability. Newspapers began to hint at trouble. Articles avoided direct accusation but used phrases like strained conditions and unusual withdrawals. Readers didn't need more. Even vague wording carried the weight of confirmation, igniting conversations in homes, cafes, and crowded streets. People who had never visited Wall Street started questioning whether their savings were safe. Political leaders entered the discussion, some urging calm, others seizing the moment to criticize the financial system. But their statements only widened the divide. Supporters of the bank claimed the rumor was sabotage. Critics insisted it was evidence of hidden corruption. Each narrative fed fear, and fear moved faster than any attempt to contain it. By now, the early conflict had fully emerged. Withdrawals increased. Investors braced for impact. Even those who believed the bank was stable began preparing for the possibility that the rumor, however baseless, might become a self-fulfilling prophecy. Because once confidence begins to crack, it rarely stops at the first fracture. The danger was no longer the rumor itself, but everything awakened in a system built on trust. The fear that once crept quietly now surged through the streets with unmistakable force. What had begun as scattered withdrawals turned into waves of anxious citizens forming lines outside the bank's doors. Men in heavy coats clutched withdrawal slips. Women held ledgers close to their chests. Clerks, overwhelmed and pale, counted out coins with trembling hands. Every payout fed the panic, confirming to the crowd what none of them truly knew, that something was wrong. Inside the bank, the atmosphere had shifted from concern to crisis. Managers huddled in back rooms, voices raised, debating whether to restrict withdrawals or continue meeting the public's demands. Each choice carried risk. Halting withdrawals might save reserves, but it could also ignite a riot. Paying out too much would drain the vaults and guarantee collapse. The institution stood trapped between two disasters, each approaching faster than the last. Rumors evolved into something sharper, more dangerous. Some claimed the bank had lost its gold reserves entirely. Others insisted key executives had fled the city. None of it was true, but truth no longer mattered. What mattered was belief. And belief, raw, fearful, and contagious, now guided every decision investors and depositors made. Markets spun out of control. Prices dipped sharply as traders dumped securities linked to the bank. Rival institutions began preparing for the shock that might follow, moving gold between branches, cutting lines of credit, and securing emergency agreements with allies. These defensive maneuvers, intended to protect against panic, only amplified the sense that a collapse was inevitable. The emotional tension reached its breaking point when a delivery wagon pulled up behind the bank, carrying what should have been an ordinary shipment of coin. Someone in the crowd misinterpreted the movement, believing instead that gold was being removed to safer locations. A shout rose. Panic erupted. People pushed forward, desperate to be the next to reach the counter before the vault emptied. Police arrived, but their presence only heightened the fear that something catastrophic was unfolding. Inside the boardroom, the institution's leaders faced a harsh reality. Their reserves were dwindling faster than anticipated. Options narrowed by the hour. Even if they survived this day, there was no guarantee they could survive the next. A single rumor had grown into a storm powerful enough to topple even the most respected institution. The crisis was no longer financial. It was psychological, emotional, and unstoppable. Across the city, businesses felt the shock. Merchants postponed shipments. Creditors demanded early repayment. Families withdrew savings from other banks just in case, spreading instability beyond the original target. What began as a localized crisis had become a contagion, leaping from street to street, institution to institution, fueled by a fear that no leader could calm. It became painfully clear that the situation was spiraling toward a moment of irreversible consequence. The bank stood at the edge, its future hanging on the next decision, the next headline, the next frantic whisper in a crowded street. The climax was approaching, swift, merciless, and impossible to avoid, and the nation held its breath, waiting to see whether one rumor would go down as a spark that brought a financial titan to its knees. The breaking point arrived with a sound no one wanted to hear, the heavy clang of iron vault doors shutting for the last time. By midday, the bank announced it would suspend all withdrawals, a move meant to preserve what little remained of its reserves. But to the crowds gathered outside, the message was unmistakable. The rumor had won. The institution had fallen. The climax hit with brutal clarity. Within hours, news spread through telegraph lines, newspapers, and crowded streets. Other banks braced for impact. Fearing the panic would leap from one institution to the next. Merchants scrambled to secure payments. Investors rushed to liquidate positions. What had begun as a harmless whisper had now triggered a cascade of fear powerful enough to shake the city's financial core. Inside the bank's offices, silence replaced the frantic energy of the past days. Ledgers lay open on desks. Clerks stared at the empty counters. Leaders who had once projected confidence now understood the harsh truth. They had lost not because of insolvency, but because of trust. The institution still had assets, still had value, still had strength on paper. But paper meant nothing in the face of fear. And then came the most painful realization of all. If the public had simply believed in the bank's stability, it would have survived. The rumor had not revealed a weakness. It had created one. The aftermath unfolded with sobering inevitability. Businesses faltered as credit froze. Families struggled to access funds that had, only days earlier, felt secure. Policymakers scrambled to reassure the nation that the system itself had not collapsed. Newspapers printed long editorials about the dangers of reckless speculation, irresponsible journalism, and the fragile psychology of markets. But everyone knew the truth. The real culprit was fear. The resolution left behind a lesson written in the ruins of a once mighty institution. Financial systems do not run on gold or paper or ledgers. They run on trust, a delicate, invisible force that can vanish in an instant. Rumors are not harmless. They are sparks. And when the right conditions exist, a single spark can burn down the strongest walls. What happened on those streets became a reminder etched into memory of Wall Street. Confidence is a currency more valuable than money itself. Lose it, and even the wealthiest institution can collapse under the weight of its own doubt.